Today's episode of This Week in Startups is brought to you by New Relic. Visit newrelic.com/twist and see why thousands of developers worldwide don't deploy without it. And by Hiscox. Do you have the proper insurance for your startup? Get the right insurance right now with Hiscox. Tailored coverage starting at only $22.50 a month. Visit hiscox.com/smallbiz to get a quote. And by Amazon Web Services. Get the resources you need to easily get started with AWS Activate, a new global program for startups, including AWS credits, training, developer support, a startup community forum, and special offers from third parties. Learn more and sign up at aws.amazon.com/activate.
Hey everybody, it's Jason Calacanis. This is This Week in Startups. Today on the program, Josh Stein of DFJ, famous venture capitalist, famous venture capital firm, one of the investors in the hottest startup, one of the three top hottest startups in the United States right now, Box. And we're going to talk to him about how he picks companies to invest in and some of his big misses. Stick with us.
That's what it's all about, man. They said money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah. Money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you.
Hey everybody, it's Jason Calacanis. This is This Week in Startups, the show where we talk about entrepreneurship, building companies, putting a dent in the universe, and all that good stuff. Apologies for my little bit of a hoarse throat. I am channeling Kathleen Turner right now. No, I got one of those little bugs, you know? Little bug. But I'm okay. It's not. I hope this is not too painful for you people to listen to me with a hoarse throat, but it doesn't hurt.
I think it gives you a certain gravitas, actually.
It gives me a certain gravitas. Today on the program, Josh Stein of Draper Fisher Jefferson. We're here at WeWork at the Golden Gate area, which is right by the Twitter headquarters. You know that area on Market, and they were nice enough to build me a studio. So I'm always nice enough to thank them for doing so. Thank you at WeWork. I have a desk here too. It's a great place to work. They have good coffee and a great group here. The launch festival coming up February 24th, 25th, and 26th here in San Francisco. Apply to launch on stage. That's a key thing to do if you want to do great things in life. A lot of great companies have launched on that stage. And buy a ticket and attend. Festival.launch.co, festival.launch.co. 8,000 people will be there this year. It's going to be awesome. So, Josh, we've known each other for a couple years. Venture capitalist.
Yep.
When did you start in venture capital?
I started about 10 years ago in 2004.
And what did you do before that?
So I kind of cut my teeth as a product manager in software at a company called NetObjects. So
Yeah.
I remember NetObjects. It was like before Dreamweaver. It was the first visual tool for building web pages.
I remember NetObjects.
Yeah.
And you were a product manager there.
I was product manager, ran the Mac product. It was the largest Series A in history for a software company at the time, $5 million. Back in, I want to say 97 or something. So
Wow.
Samir Arora, who now runs Glam for us,
Yes.
was the founder there. So I was a product manager there. Then I started a company called ViaPhone with a bunch of NetObjects
I remember
people.
that.
Yep.
Yeah. What happened to ViaPhone?
It was acquired by a company called Extended Systems. So Extended and Puma were the two sync vendors, and it ended up as part of SAP.
Was it a success or a...
Sort of modern. It was 9902. We definitely had a pretty tough sledding in terms of the overall environment.
Right.
Great learnings in terms of it, but it was sort of an okay, not great outcome.
And then you decided to be a venture capitalist. Why?
Yeah,
How?
I carried a bag as a VP of sales at a mid-size, about a $70 million company called Telefia, and then DFJ was looking to add their team. They had led my Series A in ViaPhone, so they called me up, and they already knew me, and so I started there.
So you were a product manager, founder, turned VC.
Yeah.
But at the time, most VCs were MBAs, right? Not operators or 50-50?
Yeah, I mean, I have an MBA as well.
Yeah.
But I think that's right when it was turning. I think you had this huge influx in 99, 2000. The industry went from 10 or 15 billion a year to 100 overnight. And then, this is when returns went down and all these, frankly, goofballs came in the industry.
Yeah.
One of the things we talked about, I think a lot of the things that gave VC as an asset class or VCs a bad name actually came out of that time period. And the people who came in then, as opposed to the people who are doing VC now.
Right, and that was the 99, 2000, when all the IPOs were happening.
You just had a lot of carpetbaggers come in. So basically, every investment banker all of a sudden thought, I'll start a venture firm. And it was super easy to raise money. And so, the number of firms goes up 10, 20x, 10x the capital. Very inexperienced people, I think, with a very short-term mentality. And I think if you compare it to, I say this a lot to entrepreneurs, I think a lot of the stereotypes of negative VC behavior are actually much less common with today's VCs, who I think in general are former founders, or people who have been in the business a long time and have lasted. But I think you still have the hangover of some people that came in and just, were really short-term oriented.
And all those funds, a fund takes what, 5, 7, 10 years to wind up, round up, whatever, wind down?
Oh, 10 would be great. I'd say, they've taken longer.
Really?
Recently, yeah, because so you raise an early stage fund, right? So you raise an early stage fund, you invest it over the first 3 years. Your average from first investment to IPO or exit has gone up pretty consistently 6, 7, 8 years now. And that's the average. So you're going to have some that go longer. So it's not uncommon to see a venture fund go 12, 13, 14 years before final liquidation.
And the limited partners expect, the people who give you the money to invest as a venture capitalist, for the people who don't know and listening, they expect to get a return realistically when? Or is it, do people, because that seems like an education that has to occur with those limited partners, because they think, oh, well, I'm giving you money, I'm going to start getting money back in 3, 4, 5 years, not 10, 15.
Yeah.
Or do they?
Well, there are definitely less experienced limited partners. I think if you look at the better firms, like at DFJ, most of our investors are people that have been in the asset class for quite a while and understand the business. And so we actually select them for that. So we're looking for people like educational endowments or nonprofits or insurance companies that have very long-term time horizons. Because we said, look, we're going to generate a good return, but it's going to take a while, especially from liquidity. So people are comfortable with illiquidity. But I would say that, your typical venture firm, you're going to start getting returns out maybe in year 5 or 6, and then the bulk of it's going to come out 7 through 10.
Got it.
Yeah, it takes a while.
Why did you decide to be a VC and not just keep being an entrepreneur? Because it sounds like you had a pretty good run as an entrepreneur.
It's funny. I think I was an okay entrepreneur. I think it taught me a lot about the process, and I think it gave me a lot of empathy for my founders, which is useful. I think, having done layoffs myself, I can tell you they're not a lot of fun. And so,
they suck.
They have to be done sometimes, but it's like, I think, having had to actually do that myself maybe gives you a little more humanity about the process of how it's done. The thing I realized is I actually, I think great product managers and great founders are really good at focusing and moving the ball forward a little bit consistently each day over a long period of time. I was always at my best, actually, when everything was hitting the fan. So I'm kind of like a fire drill guy. I was really good at context shifting. I was always happiest when something was kind of blowing up or on fire. And in VC, it turns out that's all the time.
Because you have a portportfolio of so many companies that one's going to be in turmoil at any given point in time.
At any given time, there's always one being sold, 2 or 3 that are financing, a couple that are doing great, and a couple that are in crisis. And so you're just context shifting between fire drills back and forth. And so I just realized that I'm actually, that's the way my personality works, better than just sort of continuous effort, over a long period of time.
10 years of doing this, what have you learned in terms of selecting companies to invest in? What was your criteria early on? And then how did it evolve, as it were?
It's definitely all about the people, and I think startups are way harder than people like to think they are, and especially when you get in a hot time like we've been in the last couple of years. You get this kind of sense like they're easy, or you're like a sucker if you aren't starting your own company. The reality of startups are brutally hard. And for an average, for just a normal person, the people who are doing startups are talented, smart people who get great jobs somewhere else. The EV, the expected value, I would argue is probably higher not starting a company. People who start companies trying to make money generally end up washing out. It's too damn hard if that's your motivation. The people who start the great companies, they have some burning desire to fix a problem or to solve a customer need, or it just compels them to do it. And you have to have that kind of like conviction that pulls you through.
It's easier to just go work for a big company and get a surefire equity award every year and get a salary.
It's like if you want to play it safe, you can just go grind it out at using the kind of the
poker terms. We play poker together, so there'll be a lot of poker references for people who are paying attention. But you can grind it out at the 5-10 and play.
You play limit.
Only a position or play limit.
Play limit. Play it safe. Get a job at a great company. There's not. You work at Google, work at Facebook. You're going to work on some fascinating stuff. You're going to get really well paid. You're going to make solid money. You're working with great people. Life's really good. I would argue your expected value is higher there
Right.
For the average person. So you don't do a startup if you're just trying to make a lot of money.
So what are the characteristics then? If you say it's a people game, which I don't disagree with, what are your filters for the right people? I mean, I've heard people say you want somebody who is a little bit of hard to deal with. Like hard to deal with entrepreneurs is a good signal that they're, a little edgy. True?
Yeah, absolutely. Because I think you're trying to do something that's by definition against the conventional wisdom. I mean, we vote on deals internally, and when everyone is in favor of a deal, we actually think it's a bad sign because it usually means it's too obvious. If it's obvious to 7 people, it's probably too obvious. And so when we have a vote where it's all thumbs up, we call it the kiss of death. Like, that company's definitely going to fail. I think you want people who are willing to. You're going to have a lot of people tell you that you're wrong when you're starting a company. People who seem like experts and people who seem like they know the market or the technology. And I think you need to have the perseverance to push through that. I'm also looking for people, frankly, who I just think can maintain that stamina and that energy through a long period of time. They just have a lot of resiliency. I think if you care a lot about, for example, what other people think about you, I think it's hard to be a really good founder. I think you've got to, the best founders, they're convinced they're right. They don't care if other people think they're wrong. They're just going to show them that they're wrong, as opposed to, getting all worked up about, what TechCrunch is saying or something.
All right. When we get back from this commercial break, I'm going to ask you to be super honest and take me through some of these amazing investments you've done and some of the misses as well, and just give me what those first meetings were like and when you made the decision. When we get back from this very important message.
Hey, everybody, what an amazing episode we're having, and it's thanks to our partner, New Relic. Yes, they do application performance monitoring. It's a tool I use myself. 50,000 customers, Nike, Warby Parker, Airbnb, Comcast, and AT&T, among others, use it to make sure their web applications are running perfectly, seamlessly, and they're constantly innovating and giving us new features that we love. The thing I love is getting my weekly email that tells me the uptime of the launch ticker and things we're doing. And I can see, oh my God, we had this problem of uptime on this day for this reason, and what the speed is of our app servers versus our CPUs, utilization, et cetera, et cetera. And this is just a great way to make your app faster and more seamless to users. And that really is one of the great big innovations of the last 10 years in technology. We found as an industry that speed and stability are the number 1 and number 2 features of any technology. Google literally beat a lot of competitors in the email space because they were faster. That's simple. And other people like Instagram beat people in the photo sharing space because they were faster and simpler and better. And what is the first thing Marissa did when she went to Yahoo? She said, make everything faster. And that just increased performance immediately. It's so obvious, but you need to have tools and you need to have a partner like New Relic to make that promise come true. Go to newrelic.com/thisweekend, newrelic.com/thisweekend, and you'll get a free This Week in Startups fan-made t-shirt for free, just for signing up. You don't need a credit card or anything like that. Thanks again to our friends at New Relic. They've been a great partner to the program. It's super fast, super easy, and no credit card is required. If you're a fan of the program, please go to New Relic, RELIC.com/twist, and get that This Week in Startup shirt. Okay, everybody thank New Relic on Twitter at New Relic, and let's get back to this amazing episode.
Yes, thank you to my fabulous sponsors and partners on the program. Couldn't do it without you. When we left our hero, Josh Stein of DFJ, 10-year venture capitalist who's in some really great companies, I'd posed the question to you, what were those first meetings like? You were one of the first investors in Box.
Yeah, I was the first venture investor.
First venture investor.
There was 3 people when we invested.
So Aaron Levie has become quite a force in the industry.
Yep.
Or Levie? Is it Levie?
Levie.
Levie, rather, yeah. Aaron Levie, quite a force. Do you remember the first meeting? And when did you know, like, hey, this is something special? How many minutes into the meeting or days after the meeting?
Yeah, I think, especially at the early stage, it's rarely like, this is going to be the next huge company. I think you're just looking for kind of positive signals. And I think in the case of Box, first of all, it was a great product. Like these guys, it was 3 people. They'd raised a couple $100,000. They'd been at it. They had almost 20,000 of MRR, of monthly recurring revenue. So they had people really using the products. Right away, they had some credibility there. I used the product. It was super simple to use. You didn't have to have any instruction. You could just get going with it. The thing that really impressed me with the guys was they were just so on it. So every question I asked them, they had a good answer. There were a couple that they didn't have the answer for, and they said, we're going to get back to you. And then like at 2 o'clock that night, I got an email from them with, I don't know, 10, 15 written pages of answers to the questions.
Wow.
Yeah.
Term paper.
Yeah. And I was like, wow, these guys are on it. Like they're totally motivated. Like they're just kind of crank it out. And it was just these great interactions. Aaron is a tremendous entrepreneur. He gets a lot of credit. His co-founder, Dylan, equally amazing, and is just probably, Dylan now is 28 years old. When he was 23, he's one of the best CFOs I've ever worked with. He is just so on top of the mechanics of that business.
That business is doing tremendous.
Yeah.
What's the status of that business? I hear it's just doing fantastic.
Yeah. I mean, we backed them. They were 3 people in a garage. They're almost 1,000 employees now.
1,000?
Yeah.
This is double Dropbox, I think, right? What's Dropbox? 500 or something?
I think that's right. I think we're about double the size on a head count.
People put those 2 companies together. Is that right to do or not?
I think there's definitely similarities. I actually think they're pretty different companies when you get down to it. I think the needs of the consumer space and the needs of business and enterprise are pretty different. And I think, in particular, the Dropbox is really based in the sync metaphor, and I think sync is not really ideal from a business standpoint. So if you have a bunch of secret documents, you generally don't want to sync them to 1,000 laptops, each of which can be stolen or intercepted, versus more of like a centralized repository model.
Document management, as it were.
But Box is doing great. I mean, they're just, they've been growing at 100% year over year, plus 100, growing 100% at 9-digit revenue scale is something that we don't see very often. And, they have 97 or 98% of the Fortune 500 as paying customers.
Wow.
Yeah.
Also, you're in Chartbeat, which I was the first angel in.
You nailed that one. That's a good one.
I saw that one and I was like, I just need this.
Yeah.
And so that's like sort of what you said with Box was you were using it.
Yeah.
How much of being a great investor is using products?
Well, so, Chartbeat's more for you than for me in terms of the use of the product.
Publisher,
I'd say, Tony, the CEO of Chartbeat, again, it's all about the people. I mean, he is a guy who will literally walk through walls. Tony Hale. Former open water sailor. I often ask entrepreneurs, tell me about something you've done that's hard. I'm trying to look for that persistence. Yeah. He's like, well, let me tell you about the time I was in 40-foot seas and the mast snapped.
Shit.
And he's been to the North Pole. I mean, the guy's literally like an Arctic explorer. And there's
a little resiliency to that.
I talked to him for about a year. So the first time I said, I'm not really sure. And
what were you not sure about?
So it was still pretty early from a traction standpoint, and he was also going after really, really big customers. So today, almost all of the major news publications use Chartbeat. Back then, it was more aspirational. So I said, well, show me
$10 a month.
Yeah, show me you can go get some. Right, that's right. It was more of like a kind of a blogging product. And now he's got BBC and Al Jazeera and
there are people spending serious money for this.
Oh yeah, hundreds of thousands of dollars a year on the product. And so he started knocking those out. And the thing I really liked was when he came back like a year later, and we talked a couple times in the middle, he had done pretty much exactly what he said he was going to do. That's great. So as an investor, that's what you're making a guess about the future. So someone who puts an anchor and says, here's what I'm going to do over the next year, if they actually go do it, I'm much more likely to believe the next 2 years.
How do you keep it positive between when you're turning somebody down? Because I'm learning as an angel investor myself. How do you keep it positive when you say no to somebody to keep that door open in case they do perform and you did make a mistake?
Well, I mean, first of all, I tell people, look, I don't have a monopoly on the truth. Just because I'm not, there's lots of reasons we may not invest, but I'm not saying that you're gonna fail if we don't invest. And I think I try and give people honest feedback, and I try and make sure that we're getting back to them quickly and being respectful in the process.
A lot of VCs have been dicks historically about like getting back to entrepreneurs. I know as an entrepreneur, I've met with people and they're just like, wow, we're totally interested, let's follow up. And then they never follow up.
Yeah, I think people read more into that. I mean, I think, part of it is it's really hard to say no to people all the time. I mean, look, I'm not trying to complain. Like, it's way easier than what founders have to go through every day. But I think, unless you are a jerk, no one likes saying no to people, and we have to say no to people a lot. And so I think sometimes people just avoid it and hope it's going to go away. I think having been a founder myself, it always stings to get a no, right? For whatever reason. I mean, it's just, it feels like that. I don't know. I can tell you a lot of the people that we've said no to end up then bringing us in deals, or sometimes the no becomes a yes later. So,
so what do you say? It's not a fit right now, however?
Yeah, I mean, if there's something that I think in the model that gives me pause about it, I'll try and give them feedback. I mean, we've given people feedback, including, hey, we're just not sure about like your co-founder, for example, which that's a really hard message to deliver, right? And you've got to say, you have to say, hey, do you want me to sort of give you some very pointed feedback or not.
And how did Steve Wozniak take that?
Yeah, exactly. Well, and clearly we were dead right on that one. 'Cause, that guy was no good.
That guy was just so difficult.
Yeah.
Listen, Woz, this guy Jobs is just too
much of a wild card.
Too much of a wild card.
Yeah.
True in version 1, not true in version 2.
Yeah. But you make a lot of mistakes in the business, right?
All right, give me your biggest miss. I mean,
it's actually a lot like poker. It's not about.
Really?
It's
How
not
so?
about. I think especially in retrospect, it sounds like it's about that one key hand or the hero call. I actually think it's way more the way the pros play, which is it's an accumulation of slightly better decisions over time.
Right. If I'm 5% better than you, I don't have to be 100% better than you, right? Like just a little bit better on each hand.
I'll tell you a funny story related to this. So the very first deal I looked at in 2004 for DFJ, I can't say the name of the company, but I ended up not doing it because I was doing reference calls, and I got the worst reference calls you could ever imagine about this founder. I mean, it was awful and just basically was like, I will never talk to this person or work with them, and neither should you. And this was like a consistent thing over like a dozen people that I talked to. 6 months later, that company gets acquired.
In fairness to me, I was a different person back then.
Yes, that's right. Well, you're way more.
Way more alpha.
Yes,
okay, so wait, the company then got acquired.
So the company then gets acquired for what would have been a locked-in 10x with an earn-out to 100x for us on the money. What do you do? Like, I maintain I made the right decision. Obviously, with the benefit of time, it turned out I didn't. But that's like, you got 3-9, and the flop comes 3-3-9, and you're like, oh, why didn't I play 3-9?
Right. That's not the proper way to play the game, right?
And in fact, if you do play the 3-9, you will lose money.
Right, yeah. So if the 99 other times somebody tells you this is a person you should never work with,
yes,
you lose.
I mean, I would say actually you're going to get a bad reference call on a lot of people. You have to do a bunch of reference calls, but like this was one of the only ones I've done where it was really bad stuff.
Right.
So anyway.
Wow, interesting. Yeah. So take me through what happens in the firm. You talked about like everybody saying yes is a problem.
Yeah.
At DFJ, does everybody have to agree to do the investment, or can like partial? Because you hear all these dynamics about partnerships.
Yeah.
And this is one of the things that people feel is a challenge to VCs now is entrepreneurs are savvy. I mean, compared to 10 years ago or even 5 years ago, entrepreneurs are much more savvy, and everybody knows like don't pick a firm, pick a partner, right? It's the sort of thing. Do you agree with that advice?
I do. I think the good firms have good partners in general, but I think the personal fit is very, very important. Mm-hmm. I mean, I think people sometimes talk about it like getting married. I think it's actually almost more like having a sibling. I mean, once you've partnered with an entrepreneur and you're in the company, I mean, you're really in, until the company resolves one way or the other, until it exits or goes out of business. And so that's going to be, like you said, it's a 7-8 year relationship. I think actually one of the best roles VCs can play, and they played it at my company, is it can be pretty lonely as a founder, right? Especially if you don't have a co-founder that you can sort of confide in. Your VC is the person who they're in there with you, they're stuck there with you. They don't work for you, so you don't have to sort of keep up the brave face as much. Right. Kind of tell them more honestly, but they're totally aligned with you. I mean, really, in a good company, everybody wins, and in a bad company, everybody loses. And there's sometimes kind of asymmetric outcomes. It's really more binary.
Right. So this idea that the VCs have a different, success metric than the entrepreneurs, that happens sometimes, but it's a very edge case.
Yeah. I mean, this is a whole longer conversation, but I think, I think there were sort of a couple eras of venture capital. You had I would say the pre-95 era where it was kind of very clubby, very small. There was a lot of information asymmetry. I think you actually had some really good VCs, and there were some fabulous companies that were built then.
What do you mean by information asymmetry?
Like there weren't that many firms. So if you were an entrepreneur, you didn't have a lot of places to get options from, and so there was less information available. So it was. It was less of an efficient market. You were less likely to get maybe a fair or appropriate market price for your company. Then I think you had kind of the run up in the bubble, and we talked earlier about, you had all these people came in that really didn't know what they were doing and acted very short. They left their Wall Street job, they raised a fund, it was a total disaster. They start panicking, they take it out on their entrepreneurs. And this, I think, is the overhang that we've been dealing with for 10 years. And a lot of the people who are the thought leaders in the entrepreneur community were suffered through those VCs.
Yeah, for sure.
And I think still have the scars to prove it. Now, I think if you look at who are the leading people in VC, they're people who have largely started companies, who have great reputations with entrepreneurs. And I think, the people who are coming into the business. So Bubba Maraka, who we just hired from Facebook, great example. he's been an entrepreneur. He's been at Facebook. He's one of the nicest people you're likely to meet. He's the kind of person who he's about as far from a mustache twisting VC as you're likely to find.
Yeah.
And I think that I think that we're you're finding VCs now who are more aligned with entrepreneurs for the long term. Yeah.
People talk about the returns on VC being bad for the bottom, percentage and extraordinary for the top percentage. What part of that is true, and what impact does that have on entrepreneurs?
So a provocative thing, I think there should probably be, I think there's 30 to 50 venture firms that are sort of worth investing in personally as a limited partner. As a limited partner, and then I think are about that number. I'm talking real venture firms, not super angel firms here. Yeah. And there are about that many as an entrepreneur that I would recommend taking money from. The industry had gone from 1,000+ firms down to 500 firms. I think there's still a lot of firms that frankly just don't make a lot of sense. I think that performance is absolutely concentrated. I don't think it's as concentrated as people think in terms of being like a small handful of firms. But I think that a lot of the knock on venture firms is related. When people say venture firms have lagged in performance, I think, you're dragged down by those carpetbagger firms that basically came in, raised one fund and disappeared. You also have been dealing with an equity markets that really didn't do very much for about 10 years. So from, 2002 to 2012, you had pretty much flat stock market.
Right.
And so it's kind of like sailing with no wind to some degree from a macro standpoint. So venture, I actually think venture returns have been excellent over the last year or two, and I think you're going to see them return to where they should be.
Yeah, that makes sense. What happens in a firm when partners can't agree on a deal?
Yeah.
Because you said before, if everybody agrees, well, then it's probably not great because it's so obvious.
So, so I think every firm's different. I think, Steve Jurvetson, my partner, has done a lot of thought leadership on this, and we really believe in cognitive diversity, that what you want is a collection of people who actually think about things, who have different experience sets. So like Steve and I have very different experience sets. We also cognitively look at problems in a very different way. And the two of us have remarked a number of times that we think we're better investors than we would be if we weren't each other's partners, exactly for the reason that Steve sees things that I won't, and vice versa. And so the ideas that emerge out of the crucible of sort of both of us focusing on and the other partners we have around the table tend to be much better than if I was just looking at them with my own lens. So we all have blind spots.
So how many people have to agree? Like if you say, listen, I'm going to do Uber, I don't care that you don't get it, or I'm going to do Box, if you don't get it, does it become you must have those moments, right?
We do. I mean, I think we...
do they get contentious ever?
Sure, but I think one of the things I like about our culture is we get really up in each other's face, but it's not about the people, it's about the idea. So, Tim Draper, who founded our firm, I'll just tell Tim, you are absolutely wrong, here's why.
Right.
And I've been doing that since I started the firm. He has never once said, hey, I'm the senior, guy.
Right, I mean, he is Tim Draper. I mean, there's something there, but he does need people to stand up to him.
That's what makes him great, though, is that he wants people to stand up to him. He wants people to argue with him. He's still going to make his own decision at the end of the day, as you all should. I mean, so the general model in which we operate is we try to favor a passionate minority. We don't go so far as to say if one person likes it and everyone else doesn't like it, then you probably shouldn't do the deal. Partially because we are a partnership, we're tied economically. It's probably not a good idea to have something that's that controversial. But if 2 or 3 partners like it and 2 or 3 don't, we're going to do the deal.
Oh, wow, that's fascinating.
All right, if the 2 or 3 are passionate.
When we get back from commercial break, we're going to go through Josh's biggest misses and a couple more of the big hits on This Week in Startups.
Hey, everybody, I'm excited to tell you about the launch of the Hiscox Reactor. It's an online experience that takes you through a personalized virtual career journey, all powered by the details of your LinkedIn profile. Every action has a reaction, and those actions can lead to business success or business failure. At the end of the journey, you'll see your image appear on the cover of Fast Company magazine, giving you insight on how it would look if you were named the Hiscox Business Owner of the Year. You can download and save this picture or share it across social media like myself. Go to reactor.hiscoxusa.com. That's right, go to reactor.hiscoxusa.com. Thanks again to Hiscox Small Biz, providing customized coverage and competitive pricing on small business insurance. We use it here at This Week in Startups, and we love it. Go to reactor.hiscoxusa.com to see yourself on the cover of Fast Company. It's pretty groovy. All right, let's get back to the program.
All right, hey, welcome back to This Week in Startups. My guest, Josh Stein from DFJ. You know the firm, Draper Fisher Jurvetson. You got your victory lap with Box there, and Angel List, congratulations on that. That's a big deal for you guys. Path, Redfin, Twilio. Wow, these are all great companies.
Thanks, man.
Opscode, actually, that's another great one I know.
Yep.
Glam has done pretty well.
Yeah.
But what did you pass on that you stare at the ceiling when you had, 2 pair on the flop and Chamath just pushes it all in and you fold and then he turns over 2-7?
Yeah. That's
and he laughs, ha ha.
Right. Yeah.
I just bluffed you for $30,000.
Yeah, even worse.
Not that we'd ever play for that kind
even
of
worse
money.
Is when he has 2-7 and he hit.
And he hit, right. He's got 2 pair.
Yeah.
And you've got an ace.
Yeah, the anti-portfolio in this business can drive you nuts.
Mm-hmm.
And again, I think you have to, it's like poker. You got to focus on your process as opposed to like looking at the individual hands.
Well, let's be brutal now. Let's go into the brutal nuts part about it.
Yeah. Well, I think
which one is burning you right now?
The one, so as a firm, the one that burns me the most would be Facebook. And like a lot of firms, we looked at Facebook, and it was just it was a hard one to get the valuation ask on a lot of the great deals going in is always seems crazy high, current, and then in retrospect it looks like an incredible deal.
Was this the $10 billion Microsoft round or the
No, this was the round that Excel did.
Which was
this
what,
was the first real venture round. No, it was it got done at 110, I think.
And you didn't even bid because of valuation.
We put in a bid at the ask was not even 110 when they talked to us. It was lower than that. We put in a bid that was under that, and in retrospect, we should have just bid way over. But it was a very different company, right? It was college student only.
Yeah.
There wasn't really.
What was that? Sean Parker was like bringing him around town.
Yeah.
And Sean's like, this is worth 100. And what was the justification?
For not doing it?
For the valuation first and then not doing it. Yeah.
Oh, it wasn't really any justification. It was, we're going to get it done at this. They had a term sheet actually from a big publishing company at the time.
Wow.
Yeah. So, but anyway, my
like a Random House, like a publishing company, like
no, I think it's
Washington
actually
Post?
Public information. So it was Washington Post.
Washington Post, right? Yeah.
Donald Graham ended up personally
that was like
investing.
a kind of a crazy story. Like Donald Graham had given him an offer and then he reneged on it.
Yeah, I don't know the details. That's what's been reported. I don't know if that's true.
That was like pretty well reported. Yeah.
But yeah,
supposedly he cried when he had to renege on the deal.
Well, then I think Donald Graham ended up investing personally.
Yeah.
And joined the board. So I think it all kind of worked out. But my biggest miss personally, the one it just drives me. The company hasn't exited yet, so I don't know how big a miss yet. Would be Jawbone. So, which at the time was called Aleph, and I met the company when their original product, people forget, was the noise canceling headset, but it wasn't the Bluetooth one; it was a wired one. So you had it was like all these wires, like there was something went in your ear, something went on your hip, and then there was like 3 wires between the two, and it was genius technology. The demo was the founder cutting a piece of wood with a chainsaw and talking on the cell phone, and you could hear him perfectly because it had the transduction.
Now that's a pitch.
Yeah,
so wait, how does he do that? He brings a chainsaw into your
he did this at demo, I think, where he had like a chainsaw and it was outside, and you could hear it crystal clear, when they turned on the noise canceling.
Wow.
And so he did that, and the problem was no one wanted a big corded headset. No. He had the plans to build the Bluetooth one. This was sort of right in 2004 when the venture industry was kind of in a funk.
Haas?
Huh?
Haas? Hussein?
Yeah. And his original venture investors had kind of abandoned him. And so he was like, I've got this big purchase order from Singular to make these Bluetooth things. I can't do it. Anyway, I basically just talked myself out of it. I looked at Plantronics, trades at like 0.8 times revenue. I thought, even if he sells $1 billion of these things, company's only worth $800 million, just doesn't pencil out. It's hardware, all the things that were wrong with it. Yeah. And now everywhere I go, I see a Jambox. I see people wearing up things. Yeah. And what I missed there was he's an incredible entrepreneur.
Dogged. Resilient.
Oh no, you can't imagine how resilient. I mean, he was
the pioneer in hardware.
He had to completely reinvent the business. He had complete investor abandonment at the worst possible time. And you look at what he's built today, and it's incredible. I mean, it's an icon. I would say both the Jambox and the Up are iconic products.
Yeah, and why hasn't Apple bought that company? Is that
no idea? I think that is the most obvious purchase for Apple. And
is that just an ego thing? Like they just, God forbid, somebody created a beautiful product that isn't in our building?
I don't know, but I totally agree with you. That is a no-brainer.
They could get it for $1 billion.
I don't think they get it for $1 billion. I think it's sell for. I don't know.
3.
I think.
What does it matter? You have $140 billion in cash.
Well, that's the better point. Yes. Yeah. I think they could get it for a quarter of cash flow, or less.
It's crazy.
Yeah. What's their quarterly cash flow? It's like 12 billion or something.
Who knows?
Yeah.
It's ridiculous. They just keep piling onto that.
Yeah. I think it'd be like a $5 to $10 billion number is my guess to buy that. But I don't know. I don't know what their financials are. But I can
Is
tell
Apple like a really frustrating company as a venture capitalist because they just don't buy a lot of companies, and there's so many that would be so good as part of Apple? They're so not acquisitive.
I love Apple. I think they.
No, I know that, but as a VC.
No, I don't want our companies to be bought ever.
Oh,
I would
okay.
much rather they don't get bought. I mean, that's the other thing with VC. Our business is driven by the really big companies, way more than
The unicorns.
The unicorns are actually, it's funny, people talk about the unicorns as being companies that get to $1 billion.
Right.
It's okay. It's actually the super unicorns. Like, we want to make $1 billion on an
Right.
investment for us.
Which means
10. Like,
Yeah.
it means generally 10 or plus,
Right.
right? It's the Teslas that drive our business, where you get to a $20, $25 billion market cap, or the Baidus, right? You know,
Right.
Baidu's worth, we owned a quarter of Baidu when it went public.
You did?
Yeah.
Wow.
Yeah. Baidu's market cap is
Where
$55
does
billion.
DFG sit in terms of returns in the last decade or so compared to other VC firms? Like, does somebody keep a list of that? And like,
I'm sure.
where are you on that list? You guys like sweat
don't
that?
know. Not really. I think we just try and do the best we can, and you know, it's people are pretty secretive about their returns. I'm sure someone has that list. But
Yeah. What else have you passed on?
Jawbone would probably be the biggest one. I was also, so as a partnership, when Uber came around for its first round,
Travis.
I was really
$5 million
not a
round or
fan.
the A round that Menlo did?
I want to say this was 5 at 50.
Okay.
Was the ask. It was
I think it
something
was
like
Menlo,
that. Yeah. I don't know if this is the one Sherbin did or before that. One of my partners
Oh,
was
no,
like-
no, this was benchmark then.
I think this was the benchmark round. Yeah,
Right, and
yeah,
then
yeah.
Menlo came after.
And
Full disclosure, I was an angel
I
in
was
the-
really skeptical of it, and now, you know, I think I spent $1,000 on Uber last month myself. I mean, and you saw the numbers that were, you know, leaked. And
What did you think of those
confirmed.
numbers that were leaked?
I thought it was awesome. I thought it was absolutely awesome.
$21 million a week?
The coolest part was going from 17 to 21 over like a 10-week span or a 12-week span,
Something like
and
that,
just
yeah.
steadily. You saw it steady progress.
Right.
I mean, that company's on fuego. It is.
So that's $3
incredible.
million increase per week in whatever number of months.
I mean, it looked like a pretty. I mean, that to me looks like a company that's growing at very. You know, people talk about, well, they're doing $200 million in their commissions, they think, but I think the top line number is perfectly. They're driving $1 billion of run rate spend right now,
Right.
And it looks to me like they're growing at 50+% on $1 billion run rate. I mean, that's
50%.
annualized growth. More. I mean, I think that's. I would think it's more than that. I mean, it
Right.
looked like they were growing,
50%
30% in a 10-week period, right?
Right.
The thing that impresses me about Uber in particular, and I think it's actually an important meta point, is he's a builder, and that's the thing that I missed. Is that I think something that I think you had this sort of bad acting by VCs, then you had this kind of counter reaction which leveled the playing field, but also introduced some concepts where it was almost like it thought of investing as being this transactional thing, like hacking venture or being a pirate. I mean, all these things have this kind of zero-sum connotation.
Right.
It's like, I'm going to get the better of somebody. It's like, as opposed to, let's build something really big together, and then everyone's going to do really well.
Yeah. He's an empire builder. I mean, he's
a builder,
building Rome.
So Uber, people use the word disrupt. I'm not a big fan of the word disruption. Disruption is like running into a restaurant or movie theater and just like waving your arms and yelling, and asking like an idiot.
Yeah.
That's not enough. I think Uber is certainly disruptive, but it's disrupting by being better.
Yeah, they built something incredibly elegant.
Yeah.
And it's disrupted the people who built something that was not elegant and was stagnant.
He's not just trying to piss off taxi people.
Yeah.
Right? His mission is not to make the guys that run black car services upset. His mission is to do better by his customers. It's an incredible service.
Right.
Redfin, which, Glenn Tillman.
Yeah.
Glenn is one of the best
Glenn.
entrepreneurs I've ever worked with. Completely mission oriented.
Now, that was a very disruptive idea. Explain that idea to the audience.
Sure. So Redfin basically said, look, buying a house is the scariest financial decision that most of us make. You're going to do it 2-3 times in your life, maybe. It's going to be the biggest number of a check that you're likely to write. You're dealing with somebody who does this every week, buys and sells a house, your agent. So they know everything, you know very little. And the incentives are completely backwards, which is, so traditionally, if you're buying a house, your agent makes a percentage of the price you pay. So the house is listed for $1 million. Your agent says, I think we should bid 1.2. Well, yeah, no kidding.
Yeah,
we're for sure going to win. You're going to get paid, and it's an extra 20% for you.
Yeah.
I mean, I can see why you want me to bid 1.2, right? I mean, it's not a great relationship. Glenn said, this is totally crazy. So we're going to hire real estate agents. We're going to pay them a base salary. We're going to pay them a bonus, not a commission. And the bonus is based on customer satisfaction, not on how much they sell. Totally transformative. And he brought a ton of technology like Uber to the whole process. So as a buyer, you can look at the website, whatever. net effect is take so much cost out of it, half of the commission he gives back to you, which is on average more than 1% of the price of the house.
Wow.
Writes you a check. So you buy $1 million house, you get a check from Redfin the day you close for like $10,000 to $15,000.
Right. It's truly significant. And people fought that one.
Oh yeah, absolutely. Just like Uber, you had all these state and local regulations that governed how you could sell real estate in these things, and all the agents had their unions, and they fought it tooth and nail, and it's been a slow process of rolling it out.
In Los Angeles, I remember I said I was going to use Redfin.
Yeah.
Because I was just looking at houses on a Sunday, and the broker said, we won't show it to you.
Right.
Literally said that.
Yeah.
And I said, do you realize that's illegal?
Yeah, exactly.
And she was like, I don't care.
Yeah. But they're fighting a losing tide there. Redfin has almost 1,000 people now working for it. Yeah, it's a huge company.
That is extraordinary.
Yeah.
So the big question of the moment, bubble or not a bubble? Snapchat, 3 billion.
Yep.
Oh my God. People are getting a little concerned. Stock market's gone up. What do you think? You lived through it. You lived through the bubble, the burst, and then the second burst wasn't really a bubble at that time. It was just a burst. We got all the burst and none of the bubble when the real estate thing blew up.
Yep.
Where are we at now? I mean, it's impossible for anybody to know perfectly, but where do you think we are at?
I think it's nothing like the dot-com bubble. I mean, that was a broad bubble where you had public shareholders and, widows and orphans kind of losing money stuff. I mean, if we're in a bubble, it's very localized. One Snapchat does not a bubble make.
Yeah.
I also think you have, as you did in 99, but I think people just got ahead of themselves. I mean, the internet, in retrospect, was a mega trend. I think you have some mega trends happening now, like mobile and SaaS and, things that are creating truly disruptive industries. Like you look at, again, Uber, I would argue, is enabled by mobile. That's that's company is not possible without the iPhone, right, or Android. So, are we in a bubble? I think valuations are healthy. I think people are being optimistic. I think we might be in a bubble in certain parts. I don't tend to do the communication platforms myself. Like I would put Snapchat in that category. Yeah. They tend to not have a lot of revenue. They tend to be things that attach on later on to something. And that, that does seem like a pretty high valuation for me. But I don't know. I mean, if that's where attention goes, and it seems like that's where the younger people's attention is going, is to Snapchat, it could be worth a lot of money.
Interesting. What do you think the best advice for entrepreneurs is today, 2013, going into 2014 now, in terms of presenting themselves when they come to a venture capital meeting? Because the world has changed a bunch. Should people be optimizing for now?
I think you should be optimizing for, it's not about winning by getting us to give you an offer or get 5 term sheets and then you can collect these trophies.
Yeah.
It's about finding someone you want to work with. I mean, if we end up investing in your company, you're going to be working with us for 5, 10 plus years. I mean, we're going to be some of your closest confidants. I would optimize for, first, get us excited about your vision, right? And
take me to that, the meeting. What should be going down in a meeting today?
Yeah, I mean, I think what I'm looking for is someone who can really crisply articulate the story, and I think it should always start with some kind of quick elevator pitch. And partially it's because I'm going to give you a half hour, 60 minutes to tell me about your company, but most people are going to give you 10 seconds. So I want someone who can get me hooked in 10 seconds. But then I'm looking for somebody who, seems like they're sincerely motivated, that has a track record of showing that they can do something hard. I actually don't care if it's exactly in the same thing. You don't need to be, if you're starting Uber, you don't need to be a 20-year guy from the taxi industry. In fact, it's probably better if you're not.
Right.
In some ways. But what I want is someone who's has gone through the struggle. I know is going to stick with it and make it happen. I'm looking for somebody who can inspire other people. So I want, if the quality of your team, can you get people rallied around you?
Yep.
When I talk to references, people are going to say, this is a guy, I want to go join him, or this is, the best guy I've worked with, kind of a thing. And then for us, it's all about the size of the market. So, when, this is something that Tim really has been instrumental in training us all. It's not so much about asking how can something fail. It's a lot more about, if this works, how big could it be? There's plenty of time to talk about how it can fail and many reasons we wouldn't think of, but what I'm really looking for is things that have that big vision. So things that are horizontal, for example, have that advantage.
Sure.
You want people who are focusing on something that's a really big vision, but they're able to sort of bite it off a chunk at a time, but it's got to have that big vision.
And so how do you give a big vision without seeming like a loon?
That's the trick, right?
Is that the trick?
That's the fine line. I think it's okay to sound like a loon a little bit.
Yeah.
I think
is one of the problems that people are just thinking too small. You see more entrepreneurs are presenting just kind of on their heels, scared, kind of small visions. That's what I see as an angel investor. It's everybody's aspiring to such small things.
Yeah, I think that's right. I think one of the things I'm really proud of DFJ is, so, and this is really the area Steve leads for us. We do a lot of deals that I would say are really big, like science, hardcore bets. Like it's like inventing the microprocessor. So SpaceX,
right.
Tesla, some of the stuff we're doing in synthetic genomics and synthetic biology, quantum computers. I mean, these are stuff like this is like hard, like stuff like maybe like 5 people in the world understands this.
Write a $10 or $20 million check, and we have no idea when this becomes a product people can buy?
I think,
or might have a 5-year outlook?
Software is definitely where a lot of the action is right now. The thing about software is it's almost by definition applied technology more than creating new technology.
Yeah.
So I think what we're discovering right now is, how do you use mobile technology to do interesting things? So Snapchat, there's no real technology in Snapchat, but what people said is, hey, if you've got a camera and a phone and a fast network, you can put it together and have this use case, and that's really interesting. That's very different than like, how are we going to launch a satellite the size of a school bus into high Earth orbit, right? And how do you actually build that rocket into? I mean, the stuff that Alon, we've had the great good fortune to back Alon's last 3 companies. I mean, he is incredible.
Solar City being the third.
Solar City being the third, which, by the way, is going to be a super unicorn for us.
Right.
In terms of that we will make, I believe, $1 billion on that investment.
Really?
When all of a sudden, it's already very close.
Wow.
He thinks big, and he's going after really meaningful problems that have like a deeper, there's some really like changing the world aspect to them.
Yeah.
Solar City, I mean, he's going after, like, not only is it a great business, but he's also like, pollution's like a big problem, right? Like we got to fix that.
Absolutely.
And, I'm proud that we are helping that. Yeah.
How is angel investing, and I don't mean this to sound self-serving because I'm an angel investor, obviously, but it seems to have changed radically, and there's a lot of talk about this class of angel investors who's now able to mobilize enough funding to essentially do an A round, or to maybe get in before the VCs and maybe push the VCs back around or something like that. Is that happening a lot now? And is that concerning to the VCs out there? Is it concerning to you? Do you feel like you're in competition with, the Dave McClure funds or Hunter Walks fund or whoever's, $30, $40, $50 million fund?
Well, that's why we invested in AngelList. It's a hedge.
Right.
No, I'm just kidding.
But it is in a way. Yes.
I would back anything Naval did. I mean, that guy, you're going to be long on Naval. I think that there will always be different stages of funds. So, like, I think, you've got the mega funds like Excel or an Andreessen that are doing billions of dollars. You've got DFJ doing a couple $100 million. You've got, Hunter and Satya's fund doing, tens of millions or maybe $100 million, and so on and down there. And I think that kind of staggered chain is a really healthy thing. I do think it's I think that stratification is just the sort of maturation of the funding chain. I think angel investing is something that will rise and fall as the sort of hotness of the market goes up and down. I think a lot of people will get hurt if they're not careful. You are, I would say, a professional angel investor. You live in the industry. You're very current on the trends. You know all the people. You have great information, and you have a portfolio of investments, right? I mean, I think, for someone to say, I'm going to, without knowing the people, just try and pick 3 deals and hope that they work. No, I mean, it's just
40 will. 50 will.
That's the sucker. 40 or 50 if you have good information and if you have good access. And I think most people who are not professionals in the industry don't understand what access really means and the volume of deals that a firm like a DFJ will see over the course of a year in terms of the... So
what is it, 200 or 300 deals a week you guys see in aggregate?
Something like that, yeah. And so
that's 15,000 deals a year you qualify.
Yeah, I don't know if it's quite that many, but it's
10.
It's many thousands. Like I would say it's it's 5,000 plus.
Right.
And I think that even the ones that we look at seriously and the funnels that are coming in, if you're some random person, you might see 5 deals and think you've got good deal flow, and you're just seeing a tiny fraction of the market, and probably the worst fraction of the market.
Yeah, because the best deals.
Yeah. But so here, there is a role for like kind of like the individual angel investor. I think what you want to do is you want to back people that you know well. So for example, when Box was getting started, the first investors were people who grew up with Aaron and friends of Aaron's parents and such, and they knew him and they said, this is a guy who's going to do it. You also have the benefit of, if you have that relationship, the entrepreneur is going to treat you respectfully, right?
Right, they're not going to grind you down or...
Yeah, they're not going to grind you down if like you're friends with their parents or whatever.
Unless it's Mark Zuckerberg. He just did it to all his friends.
So if you have like a former colleague, for example, that you think highly of, you've worked with, he's, he or she's a great person and is really smart, and they say, I'm starting a company, I think it's absolutely appropriate to put some money against that and back your friends, and I think you'll do well there. But I think trying to back people that you don't know in spaces you don't know is not going to be a great strategy.
Let's talk about syndicates, because that's the one that sort of takes angel investing and then venture,
Yep.
and might be the bridge between the two, with some of the, Dave Morin, who you're an investor
Yep.
in at Path.
Yep.
He's got $1.5 million, or
Yep.
Tim Ferriss has $1.5 million. I have $1 million.
Yep.
Kevin Rose has $2 million, but he's sort of a VC, so it doesn't count. What do you think of? Obviously, you're an investor in AngelList, so you're a little biased, but what impact if Dave Morin and I and other folks can put $1 million or $2 million into deals? Does that have on DFJ and other venture firms? We're now in competition then.
Yeah, maybe. I mean, potentially. Although I would say, I think it again, if you're thinking of the funding purely on a transactional basis, you're right in that we can both come up with $2 million. I think if you're saying, if I'm an entrepreneur, assume you're in you have a good company, you're going to have options. It's $2 million from a venture fund with a ton of connections, with infrastructure, with resources. My whole job is to invest in 5, 10 companies and then help them actively.
Right.
Versus someone who, I mean, I think of you as being effectively a VC,
right?
But versus somebody who's sort of doing it part time, who's kind of maybe running their own company, is not going to give as much. I think you're going to get a lot less help with the money.
Right.
I also think that it's not clear to me that I write a $2 million check. My first check into Sugar CRM was $2 million. My first check into Box was $1.5 million. I have $20 million in Sugar CRM and $30 million into Box now. I can go way deep, right?
Right.
So for me, the $1.5 million, $2 million, that's the pre-flop. Just like poker, I'm trying to put in most of my money in the later streets, right? But that also helps the entrepreneur because they know that we're there for them. I can support them through that.
So you think it's going to be a blend?
I think it's going to be a blend. I think it's a positive thing. I think one thing you'll find with syndicates, like you have a huge syndicate.
Yeah.
I don't think you're going to get the access to put in the full amount of your syndicate. I think people are going to say, I'd love to have Jason in my deal, but I'd love to have him in for $250 or maybe $500.
Right.
But I don't think people are going to want you in
so
for $2 million.
So it's going to be first come, first serve of my syndicate. That's what I told my
unless
syndicate.
you want to build all the infrastructure that's going to give them the same operational assistance that we're going to do.
You know what the other thing is? I don't care.
Yeah, who cares? Right?
I don't if I'm in for $250 or $25 or $500. Who cares? I just want to help. I want to be involved in fun stuff, and there's the press is kind of making this out to be this adversarial thing that's starting, but we both show each other deals because we want to work on deals together. Because if you find something cool you think I can help on, like Swell, or I find something I think is cool, and that I probably have a good palate for things. We want to work together. We want to collaborate to make things bigger. So the press is kind of making this out to be maybe more than it is, you think?
Well, no, I think it's a really cool, disruptive idea that Naval put together. And I think what it does allow is, I do think that there are guys like you or Dave or Kevin Rose who really have great access, great perspective. People want to have them in. I think having some leverage for you guys without having to go raise a whole fund yourselves, I think that actually makes a lot of sense. I don't think that it makes sense at millions of dollars level. And I think you'll find the same thing that the top venture funds find, which is you can't just walk in and invest in a top venture fund as an LP. Capital is not the problem. The top venture funds have 10 times as much capital that wants to invest in them than they're willing to take. They limit the amount of capital that they raise because they want to be able to make sure they can put it to work correctly. Because I know I can invest $350 million every 3 years for DFJ. I couldn't invest $3.5 billion, right?
And that's what got people in trouble last time.
That's what got them in trouble last time. And so I think it'll be the same thing, but smaller for the syndicates. I don't know what the right number it'll be, whether it's 250, 500, 100, whatever it is. But I think it'll be something like that is my guess.
Interesting. All right. Well, this has been a fascinating hour with Josh Stein of Draper Fisher Jurvetson. You can just call him DFJ. That's a lot easier. You can follow Josh on. Are you on Twitter?
Yeah.
What's your handle?
DFJ Josh.
DFJ Josh. There you have
Company man.
I like that. Yeah, that's commitment when you put your brand before your first name.
I didn't get the tattoo like Hunter.
Hunter has homebrew.
Hunter has the homebrew tattoo.
Yeah, I had breakfast with Hunter. He's a cool guy. I like him.
He's a very cool guy.
It's nice to see these new angel funds because they're gonna bring you stuff, right? I mean, it's great for you.
It is absolutely great for us, and it's great for entrepreneurs. Thoughtful, smart. Really great guy. Absolutely. If I was starting a company, he's exactly the kind of guy I'd want to be involved.
All right, listen, it's a great firm. Go to dfj.com. You find out all about it. Thanks to our sponsors. Thanks to producer Gina and our great sponsors, Demont for keeping the lights on, and, of course, Brandis on the ones and the twos. I'll see you all at the Launch Festival February 24th, 25th, and 26th here in San Francisco, festival.launch.co. And big plug to our friends at WeWork for building me a gorgeous studio here in San Francisco. You guys are the best. Everybody follow at WeWork. We'll see you next time.